Okay, so welcome to the recorded lecture. This will be part 1 of statutory income and exempt income. Okay, so we'll cover ordinary income versus statutory income, items of assessable income, interest from mortgage, profit making under taking of scheme, beneficial interest in income under a will, employment related allowances and benefits, and an excess distribution of a superannuation fund. So if you compare ordinary income against statutory income is specifically stated in ITA 1959. So issues that we need to consider: an amount may be both ordinary income and statutory income, in which case the statutory provisions prevail, okay, over the ordinary income unless uh, intention to the contrary exists. So if you are confused whether it's a statutory income or ordinary income because they have the same provisions or considered as the same under the same provisions, the statutory income will be the one to prevail. An amount may be statutory under more than one provision, in which case the amount would be assessable under the most appropriate provision. So if there are chances that it will be considered more than one provision as statutory income, the most appropriate one will be considered. So the items included in assessable income, we have ordinary income, statutory income, but exempt income will be exempted under ITA 1959. Okay, so let's start off with the first one under the statutory income. Interest upon money secured by mortgage of any property in Papua New Guinea shall be deemed to be derived from a source in Papua New Guinea. The taxability is not specifically mentioned, but it is impliedly stated. Source of income is more appropriate. So you have to consider the source of income first, so to determine its taxability. Under the profit-making scheme, okay, under the first limb, profit arising from a sale by taxpayer of any property acquired by him for the purpose of profit-making by sale. So that will be considered considered as one of the statutory incomes that we are discussing. It can also be, under the second limb, from the carrying on or carrying out of any profit-making scheme or undertaking or scheme. Okay, for the first limb, any capital profits which satisfy this criteria will be assessable under this provision. Intention to sell the property acquired at a profit. So if you have that intention to acquire property with the intention of selling it at a profit, that is a profit-making scheme. Profit under second limb would be considered as ordinary income. Now, under the beneficial interest in income under a will, beneficial interest in income derived under a will, settlement, deed of gift, or instrument of trust, that will be considered under the statutory income. The assessable income will include any allowances and benefits received as result of employment. So what is will? The will is a declaration of person's wishes regarding the disposal of his or her property after death. So if someone let us say wants to leave their property after their death, they can create a will. So they can say who will receive the property. Someone will administer the disposal of it. Now in settlement, that is the conveyance, usually to trustees of property to be enjoyed by several persons in succession. So the settlement of the property under the will, okay, that will be handled by trustee and enjoyed by several persons. Employment related allowances and benefits, that will be another statutory income. Allowances, gratitudes, compensations, benefits, bonuses, and premiums allowed, given or granted to him in respect of or for or in relation directly or indirectly to any employment or services rendered by him, where such benefit so allowed, given or granted would be taxable benefit under Division 3, Section 2B. Okay, with regards to superannuation, 6% is the one, or this is the minimum, okay, that can be charged or contribution by the employee, that is deducted directly from employee's pay, and then there will be employer's part, 8.4% of the gross salary. Now, any excess, okay, with regards to excess of distribution, okay, will be part of the statutory income. Okay, so the distribution made to the taxpayer from a superannuation fund being an amount in excess of the prescribed amount, except to the extent that the excess constitutes the returns of employees' own contribution. So if you receive a distribution from superannuation, your employee share will not be part of the assessable income, or in that case statutory income. Only the contribution made, or the part which the employer contributed, will be taxable, of course including the interest, or shall we say dividend, earned over that superannuation fund. Now in payouts, superannuation annuation payouts, we have employees' contribution not taxable, while employer's contribution is taxable. So as simple as that. Now with regards to contribution, if the employer's contribution exceeded 15% of the gross salary, okay, then it will be taxable. So remember, it's only 8.4 for the employers. If employers wants to give more, they can, but if it exceeds 15% of the gross salary, automatically any excess of that will be taxable. Remember, the employee and employer's contributions are not taxable. Okay, so that's it for my recorded lecture. Hope you learned something.